All right, we got participants rolling in here. Welcome, everybody.
Yeah, looks like it's catching up.
Yep. Okay, well, we're gonna wait for get as many people in here as possible because we're gonna go over some logistics for all of you. Hey, Paul, good to see you. Yeah, that'd be great. If people want to chime in on the chat, chime in. Let us know where you're hailing from and if you're gonna be a victim to the ice storm this weekend.
I know we will be.
Yeah, me too. Jordan and I are both in North Carolina, and I think we're supposed to get the brunt of it, really.
I,
It's
I
really
wonder.
sad because just like about an hour or two north of me, they're gonna get like 2 feet of snow, but I'm gonna get like a half an inch of ice instead, which is
Yeah,
way worse.
and schools will probably be canceled, and kids won't want to go outside. I'd almost prefer it to just snow.
Oh, definitely. The snow is way better to deal with.
Yes.
Okay. All right. Well, let's jump in here. So, thanks everybody for making it. A couple of logistic items. Um, Feel free to use the chat. Would love to hear from you guys. There'll be, various things that we talk about where we'll definitely be monitoring the chat and want to hear some of your thoughts and answers as we go along. Um, but most importantly, though, sometimes if you have a question to ask that you want us to address, it can get drowned out and lost in the chat. So there is a Q&A button. We'd love to hear your questions as we go. So feel free to please put questions there and we will monitor that Q&A section as well and try to address all the questions that we can. Um, so yeah, everybody please do that. And so I have that Q&A section open and we will be monitoring that as well. So yeah, again, if you're just now popping in, please chime in. Let us know where you're coming from. We got Paul down in Tampa, Florida, and Jason in Eugene. So yeah, I'd love to hear where you guys are chiming in from. So just a few introductions, and then we'll kind of talk about the big picture of what we're going to be chatting about today. So, probably if you're here, you probably know me. My name is Matthew Tringali, one of the founders here at Better Who, and we do two main things here at Better Who. One is direct hire global staffing for property management companies, and the other is coaching and consulting services for property management companies. And what that means for our clients is we build self-managing teams. So we take people from being business operators to being business owners of an asset. And so that's one of the reasons that this webinar today is something that I'm so passionate about and excited to be presenting because that is a core part of the formula for maximizing the asset that you own in your business, if you're here today as a business owner. And um, and then the other person we have in the webinar today is Jordan Coleman. Welcome, Jordan.
Thank you for having me. I'm excited.
And Jordan is with Live Oak Bank. And we've gotten to know Jordan and Live Oak Bank over the last few years. And we're really excited about what they're doing in the industry. You have a lot of banking options already when it comes to your deposit accounts, but that's not the focus at Live Oak Bank. So, Jordan, why don't you tell us a little bit more about what the focus is at Live Oak Bank and what you guys are doing in the industry?
Yeah, absolutely. Thank you for the introduction and for everyone that has joined the webinar today. Like Matt was saying, if you do have any questions that just kind of pop up, feel free to throw them in the chat, use the Q&A. Want this to be as conversational as possible for all parties involved. But Matt's exactly right. So I'm with Live Oak Bank. I am the head lender on the property management team here at the bank. And we really specialize and focus on acquisition and helping property management companies grow through the acquisition financing, working capital, refinancing existing debt to kind of help save your bottom line income and save expenses. We really found, that we're good at one thing, and that's the financing on acquisitions. So while we do have deposits, that's not really our primary goal and focus. We really want to be partners with property management owners and help them to be able to grow and hopefully one day, sell. And we're there on that side of things as well. So excited to be here, and have the joint webinar with you, Matt.
That's awesome. And a couple things to keep in mind for, for a company like Live Oak Bank is, of course, this is a great service for any of you that are thinking about doing acquisitions. And obviously, there could be a great fit here for you guys to see what your buying power looks like, and partnering with a good lender. But also, if you are ever going to be thinking about selling your company, it still would be great to have a conversation with Live Oak Bank. Just like if you're selling a house, it could be valuable to talk to a mortgage broker and get your house sort of pre-qualified for a buyer that might show up and understand what terms are available. And that same type of thing can absolutely be true for you guys if you're ever thinking about getting out of the business. Now, for me, when I had my property management company for 15 years, one of our mission statements was built to sell. And the reason why that's so important, and the reason why this webinar today is so important, is whether you're thinking about selling your business or not, the principles that you need to put in place in order to maximize the value of the business are the same principles that you want to run a great business. So no matter why you're here today, I hope you get lots of great content out of it. And as a matter of fact, I see one of my clients here in the chat, and this is like a fun story for me because this client came to me a couple of years ago now and was like, "Hey, yeah, I'm thinking about selling the business." And I was like, "Okay, well, here's what we need to do to get it ready." And after we got all those things done and we kind of started talking about, well, if we do these things, maybe you'd want to be the buyer of your business. And that's kind of how it worked out for him. Is he was like, "Well, now that I've done these things, then maybe I'm going to hang in there."
Yeah.
So there's lots of ways that this could go. Um, but just like anything in life, you want to have flexible options, right? And so the things we're going to put in place in here puts these options into place because the truth of the matter is none of us know what could happen in your life tomorrow, where all of a sudden you might be like, "Hey, it's time for me to sell," and you want to be positioned for that no matter what.
Yeah. I mean,
So yeah, Jordan.
I would just add on that everyone is going to retire at some point in their life, whether, like you're saying, it's today or maybe in 3 or 5 years, or it's not even on your radar. At some point, you're going to exit your company, and you want to set your company up for success and get your systems, your books, get everything in place, and make it be a company that, like you're saying, you would want to buy, for yourself, and get that succession plan going sooner than later, even if it is a couple years, 10, 15 years down the road. Build it up, get it ready to go, and then you're setting yourself up for success at that point.
Absolutely. We are going to be putting up a few polls today, and so we're going to start with our first poll right now. And so this question here is, how dependent is your company on you today? And you'll see there are four choices there. So yeah, let's get some poll action going, and we'll get an idea of who's in the audience today, and that'll actually help Jordan and I know how to adjust some of the content as we go here today. So I'll give that a little bit more time here before we close the poll. Get as many responses as possible. So keep those responses coming. Now, while people are putting those answers in, Jordan, let me ask you this question. From your seat as a lender, what is the biggest misconception that company owners have about what makes their company sellable?
Whew, that's a loaded question. Um, it, I guess one big thing is they only focus on top line revenue. There's a lot that goes into a business to make it sellable. And from a cash flow based lender, well, yes, your top line revenue and gross revenue is important. We're still going to want to make sure that expenses are in order, that your margins are in order, that you've got the right staffing in place, and that, your community is looking at you from a positive standpoint, essentially.
Yeah, that's great. And that's some of the stuff we're definitely going to be getting into more detail about here. So, all right. So here's how our poll results looked. So about a third of you said that the company is very dependent upon you, and another third said it's somewhat dependent. And then the remaining third were kind of split between mostly independent and only a few of you said fully independent. So that's great. Thanks for your candid responses to that poll. And that's one of the things we're going to talk about is that to maximize the value of your asset, the value of the company, you're going to want to be as independent from the company as possible, right? Because that's going to be most attractive to the next buyer to know that they're buying an asset and not buying a job. And that, if you're selling, well, you may stay on for a short period of time, you're not going to stay on for very long, if at all. And they want to know that this company is running great with or without you. So yeah, so we'll get into that more as well. So there's the poll results for everybody to see. Okay, so great. Thank you guys all for that. Now, so let's shift gears here a little bit and let's talk in more detail here about how buyers actually value property management companies. And so, there are things that we talk a lot about in the industry. We talk a lot about door count. We talk a lot about top line gross revenue, or maybe how long you've been in the business. But Jordan, give us some perspective here. As a lender in particular, what are some of the key drivers you guys are looking at when you're valuing a business?
Yeah, so those items are definitely important. The door count, your top line revenue, the years that the business has been in business. Um, but there are other things that really should stick out to a buyer and on the lender side, and things that we really look into. We're mitigating risk and mitigating and analyzing a business just like any buyer should, which a couple of those things would be the operational independency, Matt, that you had mentioned. Is the business able to kind of maintain transition with a new owner? Once an owner leaves, is everything kind of up in smoke and the people no longer either want to work there, or the owners have a very, very tight attachment to the existing business owner where it's going to cause some issues. Margin consistency is another one. We really want to make sure, again, top line revenue is increasing, but your margins overall, we want to make sure that there's not huge dips in the revenue and the margins. Have they lost doors? What does that look like? Is there staffing in place? What does the leadership team and the team structure look like? How is that going to look post transition for a new buyer? So those are a couple things that we look at. Again, that owner independency or dependency is another key factor that we really want to make sure buyers understand and have a good business plan laid out as they're looking to acquire an existing business. And we're kind of there to help you think of these things and talk through, what does that business plan look like? How are you going to transfer all of the ownership? What is the seller's role going to be post closing? How do you want this to look to make it a very, very smooth transaction? And what are the trends happening in this 3.5 year period that you need to look for? Are there red flags? Again, is there loss in door count? Is there loss in revenue? If you look on Google and there's a ton of 1 stars and comments that don't seem to be very beneficial to the company, there may be some red flags pertaining to that. So a lot of different things that you want to really hone in on as you're looking to acquire and take over a new business.
Okay, awesome. And so that's a great setup for the things we want to dive into in more detail. And so while we start that, let's put up our second poll here. and want to hear from you guys. Of the five things we're talking about here, what do you think is the biggest risk that your business has right now in terms of its value? And so one of them is how much the business depends on you, how functional your team is, what your net financial margins look like, lack of systems and processes, and just lack of financial clarity. Like maybe you're making money, but the books aren't necessarily that clean and clear about what that looks like. So yeah, let's put some of those results in. While those results are coming in, Jordan, let me ask you this. When owners think about value, they usually start with door count. What are the big things that you guys really hone in on as a lender that kind of tell the full story? Like if you're going to kind of start somewhere and really dig in, what's that going to look like?
Yeah, so there's two parts to every story, right? There's going to be the buyer side, really want to understand again this business plan and what does your background and your resume look like? Do you have your own personal liquidity? And then you're going to look at the seller side. Can the business support its own debt? Can the business that you're looking to acquire finance and support at a debt service coverage ratio that we really are striving for? Is the purchase price fair compared to that? Because you as a buyer, if you're buying a business that can't support its own debt, uh, you know, there's something that needs to be renegotiated. We want you to buy a business that's going to be self-sustainable from a debt perspective. So these are all things to really, really think about as you're wanting to acquire a business and understand, does the debt make sense? Does the purchase price make sense? And what do these trends look like?
Yeah, that's good, right? And to be clear about the debt, right? Like, most property management companies I know, they've bootstrapped their business. They may not have any debt on it right now, but if you own that property management company right now, you want to like probably think about what would it be like if there was debt on the business, and would my business currently support that? Because if I'm going to sell it, then there is going to be debt on the business, right? And so what would that look like for, the next owner of this business? All right. So let's end the poll here, and you guys can see what that looks like. So you guys again answered. Half of you said that owner dependence, how much the business is counting on you, is a big factor, and then how functional your team is. So, I mean, between those two answers alone, that's covering the bulk of some of the issues here. Um, and then, interestingly, this is very interesting. So, only 11% of you felt like your net margins were the biggest risk factor, and that's really great and encouraging to hear. Years ago, probably 10 years ago, when some of the other vendors in our industry started helping us evaluate kind of the financial situation in our industry, we did some studies and began to realize like most property management companies were not profitable and they didn't even know it. And it's easy to mask that with things like brokerage sales or other, or a maintenance business. And we'll get into that a little bit too if there's vertical businesses. Um, but this is great to hear that, we're moving the needle on this and most of you guys feel comfortable about your net profit margin. 20% of you felt like, your systems aren't there and your books, are not that clear. So really helpful stuff, and yeah, this gives us a lot to dig into here. Okay, so so let's start breaking this down here, Jordan, one at a time. So we talked about these five core value drivers. So let's talk about the first one here, operational independence. And we've already introduced this idea, but what are you typically seeing, Jordan? Are you seeing companies where that is a big issue? What specifically would you look for as a lender to be able to tell if this is operating independently or not?
Yeah, so I found that poll very, very interesting. That's kind of the key factor there. And when there is a company that is really relying on one person, the question that we always want to ask the buyers and talk to sellers about is there going to be any type of transition period? Is the seller okay being on there for a 6 or 12 month consulting period, kind of for a true smooth transition? What does that look like? But I mean, when you are doing an exchange of ownership from one company to another or one hand to another, you've got to have a smooth transition and understand when you're speaking to the sellers, how does this transition look? How are we going to transfer the management contracts? How are we going to introduce this new seller and make sure that there's a plan in place that makes sense and that you're not going to be losing, a ton of owners post transition. So make sure that there's clear communication between buyers and sellers on how you want this transition to look. Um, Matt, I don't know if you've got anything to weigh in on that, but if there's one person running the business, you really want to have a good, clean transition plan in place.
Yeah, absolutely. So I mean, it's interesting because a lot of things we're going to get into are so interdependent here. So when we talk about operational independence, that is in some ways more of a symptom than the problem. And so, because we're also going to talk about things like documented systems and SOPs, having a self-managing team, having, those organized finances. And, the reality is those are the things that kind of you have to do in order to gain the operational independence, right? And so, all of us want a self-managing team, but that has to happen first before
Hmm.
you can just be independent. If you just decide one day, like, hey, I'm going to be independent, but you don't have the right structure in place with your team to be organized and the right people in place that have those right skills and unique abilities, then, you're going to start sinking the ship, right?
Yeah.
And we see that a lot. Let's shift gears just for a minute here and address some of the questions that are coming in, Jordan. So this first question by Jason is a really good one. And he said that basically there are market conditions right now where a lot of property management companies are shrinking, not necessarily due to fault of their own, but just by the way what the market is bearing and supporting. And so how do you guys factor that in as a lender?
So, sorry, I'm a very visual person here, so let me read through this. To grow so dramatically in the last year or two due to property owners wanting to sell. How impactful is that on selling if growth has been consistent otherwise? Sorry, I just left it. I guess I'm trying to fully kind of understand the question here. So have lost doors
So
or
basically, he's saying, Jordan, right? Like if you went back a few years ago, like it was a good bit easier to grow a property management company because that's what the market was looking for. There
yeah,
were more people at that time that, had property, that's what they wanted to do with it, or there were active investors out there acquiring property.
yep,
But the market has shifted in a lot of ways. There's a lot of economic uncertainty right now, and so there's a lot of stagnation in our market. That affects both things on the tenant side and the owner side,
yep,
right? Across the board, most property management companies right now, their days on market to lease properties is significantly longer than what it was a year or two
yeah,
years ago, right? And then similarly, like their lead gen, their ability to go out and find those buyers or those property owners who are even wanting, to rent their property or have it managed, there's just less lead volume, right? And so because of that, they may be technically shrinking, right? Their door count may be going
yep,
down, but they can otherwise show that if you look back historically over a much longer period of time, say 5 or 10 years, that they know the recipe for success when the market bears it, right?
yeah.
And so, how would you factor that in?
So, I mean, it's kind of dependent essentially. I mean, I think that there are ways that you maybe have to look at potentially cutting costs to kind of get your bottom line revenue back up to where, maybe a couple years ago you had more doors under your belt, and you could kind of increase expenses. Well, if you start to, there's not as much, or such a large pool as there used to be, a couple years ago, the first place to start looking is going to be cutting expenses somewhere. Where can we consolidate? Where can we cut expenses to where maybe our margins can mirror one another, but I just have less doors than I did a couple years prior because of that pool. of homes that are available. So that would be kind of my first thought is let's look at the trends. Even if the overall door count and top line revenue is decreased, but we see an increase in margin where again you're cutting the expenses, that's almost a green flag because that shows us that you are an owner that understands how the business really is going to be operating and what you have to do to keep those margins steady or increasing if there is a shift in the market.
Yeah. Um, yeah, that reminds me, like one of the things that I never like to hear property management companies say is I am, quote, staffed for growth, right?
Yeah, yep,
And I'm just like, okay, so you're overstaffed.
yes.
Right? I mean, there may be rare exceptions to that where there's some big opportunity that you just know like this growth is coming and you need to be ready for it. But in general, when people say staff for growth, that means I'm willing to accept that I'm not that profitable right now because I'm kind of hoping and wishing, you know?
Yeah. Well, and
So,
you don't really know what's going to happen. Like you said,
right,
unless you've got maybe an acquisition, in
right.
closing and you are for sure in 10 days going to be acquiring that business, that kind of makes sense. But just to say, hey, I'm going to hire two or three people and I'm sending out a blast marketing campaign and I hope to get 100 doors from that. Well, if that doesn't happen, now your expenses have increased and you don't really have the margin and the top line revenue to keep up with that expense.
Yeah. And I think what can be really challenging about that is, your business for a lot of small business owners is kind of like your family home. Like it is an asset, but it's also like your baby. And so like there are ways in which we spend money on our family home that don't make any sense. And you would never do that if it was just purely an asset, right? But it's your
Right.
home. And so you're willing to sort of do whatever. And so for a lot of us small business owners, like we have these sort of family environments with our staff and we're like, oh, I could never fire that person. And look, at the end of the day, I always say that's the beauty of business. You get to run it how you want. But, if you're trying to make these objective decisions about what is best for the asset, right? Like, this is not my baby. This is not my identity. This is not my life. This is an asset that I'm developing. And sometimes, that's why we get paid the big bucks. Sometimes we have to make those hard decisions that person has been with you for 10 years. If the reality is you are shrinking, you may not be able to support the labor costs that you once supported, right?
Yeah. Yeah.
Okay. Thank you, Jason, for that question. Now we have another question here. What about property management agreements that are not open-ended but have fixed dates and locked-in owners? I think what the question is asking here, if it's okay for me to rephrase it here, Clay, and feel free to chime in the chat or in another question if I'm not getting it right. But a lot of folks have basically month-to-month management agreements, right? And then a lot of folks have fixed contracts, right? Where it's like, hey, these clients can't get out of this contract so easily, right? How do you guys value that differently as a lender?
Whether it's a month-to-month contract or a year-long lease contract or whatever that may look, while that is, we do want to kind of understand what that looks like. The owner concentration almost kind of trumps that side of things to where we say we really want to understand what's the concentration of owners compared to doors. If you've got one or two owners that make up a majority of the portfolio, that's
Mm,
that's a little bit more of a red flag for us than everything being on a month-to-month contract. Another thing and potential way to kind of mitigate as a buyer on the property management agreements is to have some type of clawback provision included in your agreement for the transition. So maybe that is, you and the seller agree to a 12-month clawback, meaning that you put X amount of the loan funds into a third-party escrow, and if X amount of doors are lost within a 6 to 12-month period, or whatever that metric may be, maybe it's top line revenue, maybe it's loss of doors, a portion of that purchase price gets reduced and paid back on the loan. So, owner concentration is a big thing that we want to look into. And then the clawback provision to kind of help protect buyers on if it's a fixed contract, if it's a month to month, that kind of mitigates that risk of, well, my gosh, after the transition, if I lose 50% of my portfolio, I now don't have enough debt service coverage to cover the loan itself. So, Clay, I don't know if that answered your question. But those are two things that we look into related to a purchase agreement on the property management side.
Awesome. Thank you. Yeah, that reminds me, I of this story. I knew this property manager once who I don't remember the exact numbers, but it was something like this, where he was managing around, four or 500 units. And he called me one day and he said, one of my clients is terminating with me. And they represent all
Oh,
but about 20 of the units that I manage. And I said, man, I got bad news for you. You never owned a property management company. You had a job and you just got fired.
yeah,
And
you went
so
for it.
yeah, that owner concentration mix really matters.
Oh yeah.
Yeah.
It's and we've turned down transactions and acquisitions before on where someone wants to buy a portfolio and it's very, just like your example, very, very heavily concentrated to one or two owners. And for a buyer, we would tell you it's a little too risky. There's not enough there to get comfortable because, like you said, if they leave, there goes your whole business.
Right. Right. Okay, great. So we touched on operational independence, but like I said, that's sort of the symptom, not the actual problem. So let's jump into some more stuff here. So number two, and interestingly, this was a common answer people gave, is documented systems and SOPs. Now, I don't know to what degree, Jordan, you guys are getting into the weeds on this at all. Is this something that you guys look at, or you just kind of have a checkbox for it, or not necessarily, or what does that look like?
I mean, it's something that we definitely want to understand. And to me, the overall margins and cash flow kind of help dictate that story. And
Hmm.
again, it's kind of going back to that business plan. Do you have any idea what this looks like? Is this your first acquisition? And do you have any idea about how the systems and the SOPs work? Because I mean, we all know property management has a lot of systems in place. You've got a lot of procedures in place. If it's your second or third acquisition, what system and process are you going to use? Do you have one? And we can kind of show that you are well informed of what that looks like and you're kind of merging everything into your existing portfolio. So it's more of a conversation related to that business plan and kind of verified by margins and how that would look on any type of acquisition, whether it's an existing business or one that you're looking to acquire.
Yeah, absolutely. Yeah, let's transition briefly. I'm going to come back to this point, but let's take Jock's question here. Hey, Jock, welcome. Congratulations on the merger with Pure and Home River that was announced today. Jock's asking, and Jordan, you and I talked about a bit about this as we prepared. How do you view portfolios with seller-owned doors under management? Do you completely discount those? Does it matter what percentage of them? Like, what does that look like?
Yeah, so it again kind of depends. So we will still look at the concentration and we could include seller owned doors in part of the acquisition. But it's going to be kind of the same one. Are you going to sign any type of extremely long-term agreement with the seller? Because they're the ones that's selling you the business. Two, if that's the case, we really kind of want them to have a very small portion of your portfolio that you're buying. Just like if you're buying and there's no seller owned doors, I mean, we don't want one person to dictate how much that looks. And then two, the seller's kind of benefiting from two different things, right? They're benefiting from an acquisition sale, but then they're also having their own home in that portfolio. So the question would then come to be, are you signing any extremely long-term contract with the seller? And what is their percentage of the overall door count?
And what would long term be that would make you guys comfortable?
Typically an acquisition loan is a 10-year loan term. So, depending on the percentage that the seller owns, potentially a 5-year long-term contract. If they own 20%, 15, 10%, maybe could get a little less than that. We really don't want to see any concentration with one person own really more than that 10 to 15%.
Yeah, and I will say, anecdotally, I have almost never seen it where that owner actually left those properties with the new property management company
Yeah.
long term. Usually there's some kind of agreement, whether it's 6 months, 1 year. I don't typically ever see anything longer than a year. And far more often than not, I do see them taking those properties back after that commitment period. So I think that's smart for you guys as a lender and smart for any buyer. If you are going to count those doors, I think 5 years makes a lot of sense, right? Like, put your money where your mouth is, kind of thing, for
Yeah.
on the seller's case. So,
Well, and I feel
um,
like it shows their confidence in you as a buyer that they're
yeah,
going to sign this 5-year agreement with you, or whatever time frame that is. And to me, it's a red flag if the seller won't sign an agreement with you, and says, I'm going to walk the other way, because I would be afraid as a buyer that they're going to now kind of maybe talk to other people and do something over here that you don't
right,
to do as a buyer.
right, yeah,
Got the debt tied
exactly.
to your name.
Yeah, so circling back to the documented systems and SOPs, a couple different things I was thinking about here. One of them is, even if as a buyer, let's say I feel confident I have a lot of great systems and SOPs in place, and maybe that's not as important to me, whatever that looks like from the seller. But one thing that would be really important to me, though, is their documentation, right? Like, what I don't want is all of this institutional knowledge that sits in the head of the seller and it leaves with them, right? And so, it does create a lot of value when you have great systems where that institutional knowledge is getting properly documented in the right place so that, 9 months down the road when so-and-so tenant's moving out and they're like, hey, but I had this certain special deal with my security deposit, like those notes are there and it's clear like what the situation is, right? Um, and so, but again, going back to like to keep pushing back on the operational independence piece, that is virtually impossible to achieve if you don't have great documented systems and SOPs, right? So you want to have the right tech stack, you want to have the right process workflow automation, the right culture around documentation, because that is a cultural thing to train your team to put good notes in your system. So, all that's going to be really, really critical to achieve that operational independence that you're looking for. All right, let's shift gears a little bit and talk about a self-managing team and accountability. And, again, ultimately, at the end of the day, this is the thing that helps you achieve what you're looking for, that operational independence. As a lender, do you guys at all get to know other members of the team or want to know anything about them to know that like they're going to stick around, they're fully competent, things like that?
Oh yeah, and this is a big key factor, for us as we're looking at an acquisition and you're transitioning ownership. Is one, how many people are employed by the business? What are their roles? How long have they been there? And what is in place to keep them there upon transition? Have you met with them? Some of the acquisitions are a little bit, more hush hush. But the question is then, well, have the conversation with the seller and figure out what is the plan to keep these employees there? Because a lot of times these employees are somewhat of the face of the company. If you do have an owner that is not on the day-to-day side of things, and so understanding what is the plan to keep the employees and the number of employees, what does that look like, is a very in-depth conversation that we have on acquisitions.
Okay, awesome. Great. And yeah, I mean I'm super passionate about this. I mean, this at the end of the day is the core of what we do here at Better Who for our clients is we just absolutely love building self-managing teams, people that are working in their strengths and superpowers, and with the right, labor efficiency,
Mm-hmm.
so that you're not leveraging all of your revenue towards labor, but you're doing that in a smart and right way. So yeah, this is a really good one. I'm gonna keep us moving along here. We definitely have a lot of things we want to touch on. And we have 20 minutes left, so here we go. So the next one here gets into finances a bit. So obviously this is at the end of the day of paramount importance for any lender. So, talk to us, I guess as specific as you can. Like, what are you guys looking for here when you're looking at the books?
Yeah, so one, clean books. So clean books do matter. And your net operating margin matters. How you're handling the business is very, very important. And understanding how you are operating your business and what your books look like is also very important. A question that comes up is what's included in the gross revenue. Let's say I'm a buyer going to buy a selling business, but 50% of the top line revenue is from commission sales on real estate. The other 50 is truly property management. Well, those are two different things. You've got one that's going to be somewhat reoccurring, which is the property management side, and then you've got another that is not as reoccurring as the property management side. So understanding what you're buying, understanding what your books look like, and what is included in that is extremely, extremely important. Because the margin and your bottom line net income at the end of the day is there to show us and tell us how much debt the business can support. So, the strong operators with stronger margins and have that margin discipline is going to be able to obtain maybe more financing than somebody that doesn't know anything about their books, or they've got very, very low margins and the business can't support as much debt as a stronger operator that understands their books, that maybe partners with somebody that can help them figure out where do we need to cut in expenses and kind of get that up a little bit more.
Jason is asking the question. Let's see how specific we can get here, Jordan. Are there specific margin percentages that you typically see or you like to see?
Yeah, so I mean, all transactions are a little bit different, right? Each buyer is not going to be able to obtain the same exact business that is being sold. So I would always say, a 20% margin is a really good starting point on kind of what we want to see. Anything greater than that, you're really starting to get into a great business. When you've got a 45 to 50% margin, you are running an extremely well business, but the almost kind of the flip side to that, as a buyer buying a business into that, is that's a very, very strong business. And if you make a couple different changes, there's a lot of room for your margin to start decreasing. So, 20% margin to 30% to me is a very, very great, well-rounded business. Anything below that, not that it's not a good business, but maybe there's a way that we can kind of take a step back and are there expenses that are cut? Are we running kind of everything through this business? So Jason, to kind of answer your question, long story short here, 20% is a really, really good starting point that we see.
Do you guys have a hard stop? Like if you see a business with 10%, you're like, well, pump the brakes. We got a problem to solve.
Not necessarily. I mean, again, it's all dependent on the buyer and the seller. Maybe they are overstaffed and this new buyer is coming in and says, I don't need all of this staff. Well, now you're kind of
Gotcha.
starting to flip that margin a little bit, to where you've already got an existing operator that can house all of this and there are expenses that they can cut. And there you go, your margin is kind of increased.
But they would have to specifically show you the plan of what that would look like.
Yes, I mean we would have to have a conversation about it. We would want to see, the W-2 add backs to verify this is accurate. So there's definitely two steps to that. It's just kind of dependent on that buyer and that seller.
And I see you guys are getting into the weeds, like you mentioned about the ad backs, things like, hey, is the owner's car lease in the books? Like how do we, factor that out? Like things like that you're getting into as well.
Yeah, my bottom line threshold on add backs and adjustments around 3,500. So if there are
Okay.
expenses below that, to me, at that point, you're really starting to kind of pull at as much as you can. And to me, that's a red flag.
Okay.
You don't want to buy a business to where you're putting in $100 gas bill every month. It's not worth, one, the headache because they're going to have to go find the receipts and verify that. But two, as a business owner that's buying this business, you still kind of want the business to be somewhat self-dependent without having to pull on all of these add backs and adjustments.
Yeah, that makes sense. And that's one of the things that, it I mean, we all understand why that happens, right? Like,
Yeah.
there's no secrets about this. We all get it. No judgment, no shame. but but clean books, right? Like this is not your personal toy. This is a business and an asset that you're
Yes.
trying to go. So like as much as possible, have genuinely justifiable clean books and expenses in there that could make sense to anybody who's picking them up and doesn't need a lot of extra explanation around it, right? Like that's
Yes.
always better.
Oh yeah.
Um, yeah. And then so tell me more. So we talked a little bit about sort of bottom line net margin, but tell me more about the books themselves. When you say clean books, what does that mean? What are you looking for? And have you seen like a significant difference when a property management company is using a third party, fractional CFO or something like that to manage their books versus doing it themselves?
No, so when I talk about clean books, I really mean kind of what you're referencing, where you are running every single personal thing inside of your business, which again,
Yeah.
especially if it's a sole prop and you're running in your personal tax return, and I get it, you're kind of using that as your spending, which is fine, but it's going to make it much, much tougher for you to one, sell your business because you've got all of these ad backs that sometimes aren't going to be verifiable, or two, as a buyer, you've got to go figure out and find all of these ad backs. Do you really want to do that? So, the cleaner your books are, and the more time that you spend on really trying to get it to a place to, I'm kind of talking from the seller side, but get it to a place to where you're ready to sell. You don't want to have to run all of that through your business. You want it to be, you've got your personal, you've got your business. Sure, pull a salary, pull distributions, do what you want after you've done that, but keep your business kind of separate and have clean books to be able to verify and show that to a bank or a buyer, when you're ready to get to that point.
NARPM accounting standards, do you like that? Does it really matter? What does that look like for you?
Yeah, I mean, of course, I think any type of specific industry accounting standards is always good to go by, right? Because each
Okay.
industry, each business is going to be different. You can have a brand, broad CPA, all the guidelines are going to be the same for a CPA. But when you really start to get into like the niche and specific individuals, NARPM accounting, people that understand the property management world, to me, it's always very important to look at those and take those really into consideration as you're kind of building your business and getting things in order.
Got it. All right, so the one last driver we want to look at here is brand and market position. So what do you guys look for there?
Yeah, so I guess it depends on if you're looking at this from a buyer's perspective or a seller's perspective. So from a buyer's perspective, again, if you're looking at a business to acquire and buy, you know, what does the immediate market and area say about them? Word of mouth is very huge. And then the Google reviews. What does that company say? Are they 1 stars? Are they 5 stars? What is the culture of the company? Does the staff like working there? Has there been a ton of staff turnover? So, kind of from a branding perspective, as you're looking at businesses, dig into those questions and see if it makes the most sense for you to buy. Don't, maybe the business that has 1 star reviews and they've got a lot of employee turnover may not be the best fit, versus a company that's got a really strong marketing position. They've got 5 star Google reviews. The staff loves to be there. They've all been there for 20 years. So, I mean, that's a couple things to kind of look into. Is the reputation is very important as you're looking into companies. And our underwriters here, as you're going through the underwriting process, look at that stuff very, very intently. They not that the lenders don't, but they really Google and put it in our credit memo and say to our credit team, this is the number of stars this company has. These are what people are saying about this company.
Yeah. Wow, that's interesting. Good to hear. Are you seeing a difference when somebody's actually buying the brand, like right, like buying the whole business turnkey versus, an already operating property management company that's just absorbing and buying contracts, basically?
So we at that point would probably almost look at the individual buying the company a little bit more intently and see what does their brand say about them. We understand that they're buying this business and kind of merging it up under their existing, but does that buyer's brand and marketing position have 5 stars, have good reviews, have good employees? So it may almost fall a little bit more on the buyer side and what that looks like, because at the end of the day, they've got the existing business and now they're just adding doors and contracts to it. Well, let's get a good feel and an idea of how they're operating their business.
Awesome. Love it. All right. We have another hour's worth of webinar content to get through in the next 10 minutes. So I'm going to pick and choose here a little bit. One of the things that we talked about when we were preparing that was really fascinating to me is you mentioned that that your multiplier on the business is pretty different when you look at door count
Hmm.
and when you factor in, correlating vertical businesses that if they're selling those along with it, like a maintenance business, for example.
Uh-huh.
So let's talk about each of those things. 'Cause I'm really curious what that looks like.
Yeah. So, as always, it's very dependent on the transaction. Again, each buyer it dictates how much that transaction is going to look like. So, same kind of goes with the door count. So, typically, it's dependent on the area, the door count, and the rent that they're receiving kind of dictates what that multiple looks like. So, typically kind of our median range and starting point is any portfolio that has 100 doors or less, your multiple is probably closer to 2.5 times of that EBITDA figure. And then as you start to kind of grow and expand and you've got 250 doors, 300 doors, you now are going to have a little bit of a more multiple because there's more EBITDA or net operating income for us to be able to pull from, to where you may be closer to 3.5, maybe 4 times, based off of the cash flow. So again, kind of going back to preparing and setting yourself up for selling at some point, even if you're an existing operator or you're buying your first acquisition today, the more doors that you buy and have under your belt, and the better that you can get your margins and cut your expenses and have a really well ran business, the more you're going to be able to receive and a return when you're ready to kind of sell, whether it's to family members, friends, or your property management company next door, but it may be in 10 years. So margin and the multiple is really going to be dictated by a couple different things, but door count is going to be one of those.
Yeah, I mean, this was so fascinating for me, and I read this statistic recently, and it has really stuck with me. That 50% of property management companies are managing 100 units or less.
Yeah. Wow.
50%. And only 15% of management companies are managing 500 units or more.
Yeah.
And so, and these numbers are really fascinating to me. And this is something I tell people a lot. I really like for property management companies to get to at least 250 units because a lot of things happen around that size. Number one, as you already said, you just immediately have turned a lever and you've created a lot more value for you
Yeah.
versus if you're only managing 100 units. Number two, at 100 units, it does depend on you. You won't have a self-managing team at
Yeah.
100 units, but at 250 units, you absolutely can have a self-managing team. You can achieve that operational independence. And at 250 units, you can really start to justify like having that meaningful separate maintenance company, which we didn't really get into that and we don't have enough time to get into it now. But one of the things you told me in prep was like that's big. Like if they have this second business and both of them are equally profitable, like what you don't want is one is just a loss leader for the other. But
Right.
if they both can genuinely stand on their own 2 feet and they're being sold together, like you have created significant value for yourself as a seller. So yeah, all that was very fascinating. All right. Um, give me let's put up the last poll here, Val. Um, yeah, this one here. So guys, chime in on this question here as we're wrapping up. What do you believe most influences your particular company's valuation today? Would love to hear that. Is it your total door count? Is it your gross top line revenue, your net income? Or if you don't know, let us know you don't know. All right,
Yeah.
while they're answering that, Jordan, give us like a 2 minute version of a real life story of a sale that you guys worked on that almost got to the finish line and fell apart.
Yeah, it's going to be related to geography, location, and staffing. So, we are probably 3 weeks out from closing, and they wanted to buy in a completely separate state, which one is already a little bit risky, at least to the bank's perspective. We really want you to be able to run the business, and you're there. And so that company was really dependent on three specific employees, or might have been two or three different employees that were really the face of the company, and that were the ones kind of running the day-to-day operations. And so we, from the bank's perspective, said, one, we want to have some type of agreement in place with these employees that they're going to stay on for the term of our loan, or at least a majority of the loan. And we want you to meet them in person to verify and solidify that they're going to stay there post-transition, because you don't live there. And they're the face of the company. And the seller and the buyer could not come to an agreement on that, and buyers were the ones that said, I'm not comfortable with it. And he explained why, and we were 100% on board with, yeah, I mean, if you can't meet with the employees and the staffing and the ones running it's not something we're going to be able to get behind.
Thank you for sharing that. Okay, everybody, hang in here for just a few more minutes. Now, Jordan, there's a lot of content we didn't get to that we definitely could have shared with everybody.
I
Let me
know.
share these poll results. Very fascinating. Basically, it was equal across the board that people are seeing total door count, gross revenue, and their net operating income that kind of equal answers here. So that was really interesting.
Yeah.
Um, Okay. So, Jordan, I think you and I have an opportunity to make some extra videos after this webinar and shoot them out to people, because there's a lot of stuff we didn't get to that I know would be valuable. If any of you guys have any questions we didn't answer, put them in the Q&A now, and we'd love to still get back to you with some answers, or any other comments in the chat. Um, just to close up here, a couple different things. Number one. Jordan is a great resource for you guys. Will you be providing us with a copy of this? I think so. Not totally sure, Sandra, but we'll figure it out. We'll make sure to at least get the attendees a copy of this. Um, so, let's see. Jordan is a great resource for you guys. If you're thinking about, acquiring, obviously she's a great resource. If you're thinking about selling, again, that would be a great, a great conversation she'd be happy to have with you. Jordan, type your email address in the chat here for everybody so that
Okay,
they
yeah.
have it. Um, so feel free to reach out to Jordan. Now, in terms of us here at Better Who, everything that we talked about here in terms of getting you guys in the most sellable position, getting you guys to maximize the actual asset that you own and manage right now, that's what we do here at Better Who through global staffing and through consulting and coaching. Many of you on here are already our consulting and coaching clients. Thanks for joining us. And many of you aren't. So would love to hear from all of you. I'm happy to offer any of you guys just a complimentary coaching call, no cost, just to have a conversation, see what you heard here, where you think you need some pointers, and would love to have that conversation with you. You can email me directly. There's a link that we just put in. You could also email me directly at matthew@betterwho.com. Um, all right, we have 2 minutes left. Let's see. We do have another question here. Richard is asking, what issues would I have selling a 100 door company with a virtual office, and my wife and I are the only employees? I Jordan, I'll let you chime in. I mean, my stance is every asset is sellable in some form or fashion, right? Like, so there's no no's here, right?
Right.
But as we've already talked about, like his multiplier may look different, his path forward may look different. But Jordan, what would you say to somebody in that situation?
Yeah, I mean, I think in this situation, finding the right buyer is key. If you've got an existing property management operator and they're tacking on 100 additional doors, it's going to be, less risky and maybe a little bit more attractive than a potential first-time operator that's not in the area, hasn't been in the property management space. So I think, and Richard, I'm happy to kind of have a more further conversation with you on this, but I think finding the right um, buyer is very important and key in what you're looking to do.
Awesome. Great. And thank you guys so much, Jason and Sandra, chiming in and recommending what we do here at Better Here. You guys are great clients of ours. So happy you're here on this webinar. Um, all right. We have 60 seconds left. It's now or never. If anybody has a last minute question, oh, time's up. It's 4 o'clock Eastern.
You had 12 seconds.
So, okay. Well, again, thank you guys, everybody. We'll conclude the webinar now. But again, Jordan, thanks so much for joining us. And like I said, I have a feeling we have an opportunity to create a few more little videos we can send out to people because there's a lot of great stuff we didn't get to. So,
I know. It probably was another hour of things.
yeah, this should have been a 2 hour webinar. All right. Thanks,
Awesome.
everybody.
Thanks. Bye, everyone.